Hey guys, Brian Stevens here with Mortgage Shots and the National Real Estate Post coming to you on a Monday. And boy, do we have something to talk about today. As you probably heard last week, Fannie Mae is doing away with credit scores. That's right, subprime is back. Anybody with any credit score who could fog a mirror can go ahead and get a Fannie Mae loan. Wouldn't that be nice if it was that easy? Actually, I don't know if it'd be nice if it was that easy because we've had it kind of that easy before and it didn't really go well. But I have had calls from real estate agents who I work with who said, hey, can we go through my database and go back and check everybody out to see if they qualify for a loan where they simply didn't do before because credit scores? And the answer is this. Fannie Mae is not going to change diddly squat. Or it just won't have any real practical application. So, for instance, with FHA, you can go down to a 500 credit score. When was the last time you did a 500 credit score for somebody? Further, if you watched my show yesterday, go back and watch it. We talk about your average credit score per loan. And your average credit score per loan is significantly higher than it was a decade ago. Meaning credit scores don't have as much of a bearing or impact as we've had before. Somebody who was a 680, 20 years ago is a 750 today. And I'm going to show you why that is. So if somebody is below a 620 today, a 620 today was a 520 2 decades ago. And if they're going to go below a 620 down to a 580, that was a 480. In order to get a 500 credit score, you actually have to really work at it. It's not easy to do. You have to screw up everything on your credit report. And then, and only then, you have to go back and convince people to extend more credit to you when it's wildly apparent that they shouldn't, to give you more credit, and then you get that credit, you charge it up, and then you charge it off. It's quite impressive. But anyways, I want to go through this, and I want to talk to you about loan level price adjustments. And this is for real estate agents and some loan officers who are relatively new, because this is the market that we're going in. It is also worth pointing out, though, that, and I've said this a lot, is Fannie Mae, Freddie Mac, and even Ginnie Mae, which is your FHA and VA loans, they are very exclusionary in nature. If you're talking to an underwriter right now and you're doing an A-paper agency loan, and it seems like it's hard as shit, it's because it is. They're trying to find ways not to do these loans, not trying to find a way to do these loans. On the contrary, when you go over to non-QM and you work with somebody like Angel Oak, I think those guys do a fantastic job. They're trying to find a way to do your loan. They are inclusionary. Agency exclusionary, non-QM inclusionary. And that's one of the main reasons why we see non-QM growing so quickly. But let's delve into what we're talking about right this minute. We got that and a little bit more. And of course, any questions that you have or anything that you want to add to it, put it in the comments down below, like and share and all that good stuff that you're supposed to do, because it helps me. And if you have any questions, you can always reach out to me. There's my number right there. Send me a text. It's always better. My name again is Brian Stevens, and I'm with the Loan Factory. Mortgage Shots is my video blog and the National Real Estate Post. Let's get moving over to it. Okay, so here we go. Okay. So, and by the way, I'm doing it this way. It'll become apparent here in a second. This is my rolling presentation that I bring to you guys, my latest one. But what I want to do here is just kind of be able to show you something, and I can't do it when I'm in play mode. Okay, so Fannie Mae is removing minimum credit scores. And they're doing this for DU. The current 620 minimum credit score representative is a representative average or median credit score. It will be removed for new loans case files created on or after November 16th, 2025. So you can go back through with your clients, or you get new clients and you have a 600 credit score, and you can go ahead and take a run at Fannie Mae and Freddie Mac. Word to the wise, they're not doing 620 credit scores right now, so I don't think they're going to be doing 580 credit scores tomorrow. And truth be told, it's not Fannie and Freddie who are doing this. Fannie and Freddie are setting the guidelines. They're not the ones who are lending the money out there. So Fannie and Freddie says, now you can go down to 500, whatever it is you want to go down to. Now you have to find a lender who's got to put their neck over the chopping block to write that loan, because when it fails, and if you have a 580 credit score, there's a pretty goddamn good chance it's going to fail. That loan is going to have to be that loan is going to have to be bought back. And as I told you before, a lot of these are going to be mislabeled fraud. You will see fraud increasing in the coming months. The mortgage industry is debating changes to the loan level price adjustments, focusing on affordability versus risk. While some advocates for lowering fees to boost affordability, others warn of revenue impacts amid a potential Fannie and Freddie stock offering. Well, I mean, they're going to lower the credit scores right at the same time they're talking about doing a public stock offering and the government taking a backseat. You see, right now, the United States Treasury basically, by and large, owns everything Fannie and Freddie. Now, they're going to forego their shares, get rid of their preferred stock, and they're going to give ownership back to those who've invested in Fannie for decades and decades and decades. At the same time, they're going to take the onus of responsibility off of their shoulders over at Fannie Mae and Freddie Mac. They coincidentally say, hey, listen, we'll write a loan for anybody now. You can have a 520 credit score, and Fannie and Freddie will do that now. The lenders are going to look at that and say, not a chance. We want nothing to do with people with those credit scores that low, because you're going to come back at us and accuse us of fraud for writing that loan when something goes wrong on it. Then we'll have to buy it back, and it will be part of the scratch and dent market where we lose our ass on it. Nobody wants to do that. And that's exactly how this thing is going to play out. Further, the everybody deserves a house mentality that we've had over so many administrations, and it is really warm, fuzzy, and feels good. The truth of the matter is everybody should not have a house. And I'm not saying this from my personal experience, nor am I casting judgment on anybody in particular whatsoever. What I do know is during the subprime debacle and what we have going on with FHA, which is a government-sponsored subprime loan, is they simply don't perform as well when you get people who have lower credit scores. That is a fact of the matter. You get to the point to where you can get first payment defaults. Oftentimes, more oftentimes than not, those who are defaulting tend to have lower credit scores. So I understand the hesitation from lenders. They don't want to get their hands slapped and be the ones who are holding that note at the end of the day when it does default. What this really boils down to, guys, and I want to show you something right now. Again, this is for real estate agents and some loan officers who maybe don't understand. But if they offer somebody with say it's a 520 or 550 credit score, that is going to come at a cost, and that cost is going to make that loan even more risky. How is this going to happen? It's going to happen through Fannie Mae and Freddie Mac's LLPAs, also known as loan level price adjustments. So let's take an actual look at what LLPAs look like and how you can determine what type of add to your fee and or your rate you're either going to have to pay or get as a benefit back to you. The benefits have by and large disappeared when they changed their LLPAs recently, but let's take a look. Okay, this is your purchase money loan level price adjustments by credit score and loan to value. Up across the top is our loan to value. So let's say that we have, we want to go 80 to 85% loan to value, okay? And let's say we have a borrower who has a credit score of 640. So what we have to do is we have to get our matrix and we have to go check out and see what that add is going to be. As you can see here, that is going to be a 2.5% hit, and that's going to be a hit to your fee, okay? What that means is that you're going to have to pay significantly more. Now, if you have a credit score that is 639 or lower and an 80% loan to value, or 80 to 85% loan to value, you're going to be right here with a 2.875 hit. If we go 75 to 80%, here's what our hit is going to be. But you can see how, by the way, isn't this really weird? Look at this. If you have a 80% loan to value with a 630 credit score, you have to pay an additional 2.75%. However, if we were to go to 90% loan to value, or excuse me, 95% loan to value, you have a 1.75 hit. That doesn't even make sense, does it? Okay, so if this is our case and we're going to go 80% loan to value and 75 to 80% loan to value, we're going to have a 2.75% hit. The question I have to ask is, if we are going to go below a 639 credit score, how much additional hit are we going to get with the loan level price adjustments, even if they choose to do it? Because Fannie and Freddie, they are going to do this. If they're going to guarantee a riskier loan, they're looking for more money in return. More risk, more reward. But that also is a double-edged coin, isn't it? The other side of that coin spells out something bad. With that risk also comes the possibility of complications or defaults. And defaults could have a massive impact on Fannie Mae and Freddie Mac's reserves that they receive through the G fee. That G fee, or a guarantee fee that they charge, and the money that they make from the loan level price adjustments are intended to go to those who invest in mortgage-backed securities that are backed by Fannie Mae and Freddie Mac's implicit government guarantee. So if you get foreclosed on and that investor loses out on $50,000, Fannie Mae pays $50,000 to make that investor whole. That's the idea. Now, what the federal government has done in their infinite wisdom is they have not allowed Fannie Mae and Freddie Mac to appropriately recapitalize. What does that mean? Well, during the last meltdown of 2008, Fannie Mae and Freddie Mac were on the verge of going bankrupt. That's when the government took them over. That's when the Treasury gave them a blank check to stay afloat. It doesn't matter how much money you have or don't have. Now, the government should have done this because what the government has been doing for years and years, and it goes against the charter of Fannie Mae and Freddie Mac, and frankly goes against Congress, is they have reallocated the money that Fannie and Freddie has made towards items, towards projects and programs that have nothing to do with housing. For example, before the last meltdown, we had this thing called the Gulf spill, the British Petroleum Gulf spill. Do you guys remember that? When that offshore oil rig basically blew up and they were shooting hundreds of gallons per minute of oil into the Gulf and the whole Gulf turned black? Well, that was British petroleum in what we now know as the Gulf of America. Boy, I bet that pisses some of you off. But here's the thing. To clean that up, British Petroleum neither had the money or the resources to do it. Who ended up floating the bill? The United States taxpayer, but more specifically, those taxpayers who bought a house. Because in that house, through these loan level price adjustments that you're looking at right now that raise money for Fannie and Freddie to fill their coffers, to guard against future foreclosures for investors in mortgage-backed securities backed by Fannie and Freddie's guarantee, they took that money and they used it to clean up the freaking entire Gulf of Mexico. That wasn't cheap, nor is it the charter of Fannie and Freddie, yet here we are. So Fannie and Freddie get privatized. Fannie Mae comes out and says, we're going to do loans for anybody. They're going to do that with a risk or reward model, which is charging people who can least afford it, those with low credit scores and oftentimes high loan to value, higher fees. Now, if we're trying to serve underserved communities and often those on the lower socioeconomic rungs, should we make it more expensive and difficult for mortgages for them, or should we make it cheaper for them? Now, I'm assuming that we want these loans to perform. And for these loans to perform, they have to have low debt to income ratios. And the way to do that is through sales price and interest rate. And Fannie Mae is guaranteeing through their moves that they're going to take on significantly more risk with higher interest rates. There's no two ways about it. Further, if you're a loan officer who finds a way to do somebody who has a 600 credit score, and that person happens to be in a underserved community in your area, you're going to be selling interest rates that are higher to those on the lower socioeconomic runs and also those of different ethnic backgrounds with higher credit scores, which are going to screw up your HMDA data significantly. And you, through no fault of your own, courtesy of Fannie Mae and Freddie Mac, could find yourself in violation of disparate impact as it pertains to redlining and the Dodd-Frank Act. Not good at all. So is this well thought out? I think probably not. Now, if we go down here, of course, we have the same type of thing. We have additional ads on top of these ads. So if you have an 80% loan to value with a 630 or lower credit score, you have a 2.75% hit. Let's say that it's also a condominium that you're going to live in, provided you can still buy a condominium. And we have to go over to our 80% loan to value, and you're going to see that we have, or 75 to 80% loan to value. Then you can see we have an additional 0.75 hit on that property. So we have the 2.75 here, add another 7.5. We're sitting fat and happy, aren't we? At, let's see, what is that going to be? 1.5 on top of that, 3.5%. 1, 2, 3.5%. You're going to be sitting fat and happy, adding 3.5% to the price in order to get the rate that you're looking for. Again, somebody getting a condo, maybe got money from mom and dad, credit score's not so good. You're going to take it on the chin, and that rate is going to be significantly higher. Again, that's if you can find a lender who's going to write this loan. And I'm telling you right now, if you do, you're going to be spending an exorbitant amount of time on trying to get these deals closed, because that's kind of how it works. Loan level price adjustments, it's the same type of thing over here. What you're looking at here is a cash out refinance and the cost on that. And then you have a limited cash out refinance, which is also known on the bottom here, a rate and term refinance. So your rate and term refinance, you get your ads here. And then if you're going to pull cash out to fix your house up, here's some additional ads. As you can see, this can get expensive. And of course, down here is we have loan level price adjustments that are going to be a benefit to your client. Okay. Now, this is if they've done some home counseling for home ready, home style, and their energy efficiency. Refi Now loans. This is specifically not refinancing a loan. The program is called your Refi Now loan. And your loans on home path property, all are going to pay your borrower back $500. If you have a home ready loan to a very low income purchase borrower, defined as 50% of the median area income, the area's median income, where at least one borrower is a first-time home buyer, you get $2,500 cash back. Hardly enough to offset the costs that we're going to incur over here that are added. So we add money that the borrower has to pay, we subtract money, and that's how we find what your adjusted interest rate is going to be on all of your Fannie and Freddie deals. So they're going to have to increase their matrix on this, and they're also going to be putting out loans that nobody's going to write. Again, all we have to do is look to FHA. Nobody's doing anything with a 500 credit score, even though FHA will allow it. It's a pretty interesting graph here. This is consumer sentiment. This is how your clients feel about the market right now. All consumers collectively, it's as low as it's ever been. And independent consumers, it's as low as it's ever been. So we can hear during the election cycle we just saw last week how everything is going great. But the truth of the matter is your clients right now are very bearish when it comes to owning homes. All they have to do is turn the news on, see all the bickering and the political infighting, and then look at some of the statistics that are coming out that are making it to our mainstream media now in terms of interest rates being higher. Interest rates are higher than the lowest they've ever been. They're still really good. They really are, and that's what your messaging should be. And the fact that properties aren't moving and that sellers are holding on to their prices. This is enough to keep anybody on the fence and make them depressed about any future outlook to buy a house. New construction premiums vanishes. Prices for new homes, home builders are going away from trying to incentivize you. And we talked about this yesterday. There's some builders who are offering 1% interest rates on mortgages. Do the math on that one. And they're still finding that people are on the outside looking in, and they're not biting at the sales prices that we currently have. Buyers believe prices are going to come down, and you can give them a 1% interest rate, and they don't want to buy the house unless prices come down. You need to understand that when you're talking with your clients. You need to understand that, especially if you're a listing agent and you're going out there and listing a property. You're going to have massive pressure from your sellers to go ahead and list that property higher, or maybe what the Zestimate says. But the truth of the matter is buyers are on the fence and they don't care what interest rates are doing. So new home construction, what are they doing right now? Well, they're pricing new homes. Well, they have fallen below resale for the first time ever. Isn't this a trip? What an anomaly for a market. Our buyers out there, our independent buyers, are holding onto their prices more than new home builders. Again, I've talked about this before. I blame Zillow. I put this in here just because I found this absurd. I don't know anything about it, but Tesla shareholders approve a $1 trillion pay plan for Elon Musk. Tesla shareholders approve CEO Elon Musk's historic pay package at the company's annual shareholder meeting in Austin, Texas. The company said that the proposal received 75% supporting votes from the shareholders. And Tesla introduced the package in September, and that's exactly where we're at with it. $1 trillion. Okay. Put it in the comments down below. Kind of curious. Does anybody really need $1 trillion? It's amazing. It's crazy. All right, the average FICO score, we talked about this a moment ago. FICO scores are higher today than they've ever been. If we go back to the year 2000, 2000 Y2K, we had an average credit score that was about 688. Now the average credit score is 716. People do not change their habits. What happens is the credit scoring models turned that 675, 678 bar, they turned them into a 716. But it's still the same bar with the same spending habits. If you don't like credit scores being as low as they are, all you have to do is change them for everybody across the board. I don't know how this helps anyone, but what I do know, as I told you before, that person who has a 500 credit score today, a couple of generations ago, they were in the 400s. Mortgage borrowers in the United States have an average credit score of 758 as the second quarter of 2024, and this is according to data from Experian. This puts them more than 40 points ahead of the national average credit score of 715. Ain't that interesting? One of the benefits of owning a house is you generally get a bump in your credit scores. Just as credit scores have broadly trended upwards for several years for all consumers, so they have for mortgage applications as well. Since 2016, average FICO credit scores for all consumers rose from 699 in 2016 to 715 in 2024, and this is according to Experian. Meanwhile, those with mortgages in their credit file saw a similar sized increase from 739 in 16 to 758 this year. We're cooking the books on credit scores, guys. That's why offering even lower credit scores is kind of shocking that the GSEs would come out and do this, but it stands to reason they're doing it when they're taking the responsibility for covering those future defaults and they're putting them on the shoulders of Joe and Jane, investor / taxpayer. Okay, credit score averages. Check it out. Jumbo loan 768, conventional 738, FHA 645. Look how much lower FHA is than everybody else. That's why FHA, if you want to find out the direction this market is going to go, look to FHA borrowers. They will be the first ones coming out of the gate with foreclosures. More so than non-QM. Isn't that interesting? Your average non-QM borrower has a credit score well above 7, and they have the similar type of down payment capabilities as those with jumbo and conforming loans. Credit score by age. Got it figured out by the time you're 60 to 78. Gen Xers, those are people 44 to 59. That would be me. 661 credit score. Millennials, the same thing. And then your Gen Zers still have those college credit scores. Hey, listen, guys, do me a favor. Reach out. Again, my name is Brian Stevens. If you have any questions, by all means, reach out to me. Put a comment down below. Give me a call. Better yet, send me a text. Of course, if you want to hear about being on our team, because we do marketing a little bit differently, yeah, let's have a conversation. If not, go to Mortgage Shots. If you subscribe to Mortgage Shots, you'll get my daily show, about 5 to 8 minutes. It's kind of this condensed a little bit. It'll be delivered to you every day. And you do with it what you choose. I hope you share, subscribe, and keep conversations about real estate going, because as I told you yesterday, we are in desperate need of great real estate agents and loan officers who will go out there and train and educate borrowers and dispel the misnomers about what's taking place in mortgage lending and real estate today.